Hey everyone, UiPath reported quarterly earnings results that sent the stock price down by 7% on the day after the results were released. So in this video, I'm going to review UiPath's latest financial release, and I'm going to update my buy recommendation for UiPath stock. I had upgraded UiPath stock to a buy, I want to say 6 months ago or so. So in this video, I'm going to update that recommendation and let you know if I'm keeping it as a buy or downgrading the stock following the earnings release. So without further ado, let's take a look at this interesting automation platform. All right, like I mentioned, the stock price is down 7% on the day following the earnings release. Initially, the stock price popped following the earnings release, up 7%, and then now it's down 7%. And it just goes to show the amount of volatility there is around an earnings release. There's extra risk when you're looking at a company around its earnings release. The price moves much more violently than it normally does following or surrounding an earnings release. So as to its revenue, the company generated record quarterly revenue of $405 million, which was a 31% increase year over year, and the company achieved its first ever quarter of GAAP profitability on the bottom line. That's great news for UiPath stock investors, especially as the cost of capital has increased. Growth stock investors are looking for companies that can sustain themselves, that are profitable on the bottom line, and are generating positive cash flow from operations, so they don't feel the need to have to go to investors and ask for more money. UiPath now profitable in the latest quarter. The dollar-based net retention came in at 119%. Just to remind you, this measures how much an existing client spends with you year over year. So a number over 100% means that a client increased their spending with you by 19% from the previous year. That demonstrates that you're providing a great return on investment, because if you weren't, then your clients would not be increasing their spending with you. They would be decreasing your spending with you, right? Because you're not delivering good value. So they're going to say to themselves, we don't want to spend more money with you. We're not getting a good return on our investment. Here, you see UiPath demonstrating good return on investment as evidenced by its dollar-based net retention rate. The GAAP operating income came in at $15 million. That was a solid improvement. Non-GAAP operating income of $111 million was also really strong improvement. And finally, cash flow from operations at $146 million. We're going to see later the company expects these metrics to continue improving for its next fiscal year when we look at UiPath's outlook for its next fiscal year. The company has a pristine balance sheet, $1.9 billion in cash as of January 31st, and roughly relatively zero debt. Now, this is even more important now that interest rates have increased over 5% for short-term government bonds. That means UiPath can generate roughly a little more, probably, than $100 million in interest income by investing this cash balance in government bonds. Super safe government bonds. It can earn $100 million in interest income. And you could see that's almost as much non-GAAP operating income the company generated in the latest quarter, right? It can earn that for the year just by parking this money in super safe government bonds. That's why cash is more valuable when interest rates are significantly higher, because of the opportunity cost, because it costs more to go out and borrow and raise capital. You can also use this money strategically. UiPath can go to customers and say, let us sell you our products and services, but you don't have to pay us for 3 months, or you don't have to pay us for 6 months. We'll let you owe us for 3 months or 6 months or 9 months because we have the cash. We're not desperate for cash. We'll let you owe us. You can pay us back slowly, right? So they can use this as a strategic advantage against competitors who maybe don't have cash and they're going to need payment sooner, so they can't offer customers better terms than UiPath can offer. So this cash is really an advantage, and more so now as the cost of capital has increased. For the full year, revenue increased by 24% to $1.3 billion. Management saying that looking ahead to fiscal year 2025, this afternoon's guidance reflects typical seasonal patterns in the business. Their guidance for the next quarter is for a sequential decrease in revenue, as well as our plans to strategically invest to further expand our market leadership while continuing to drive operating leverage. And they did indeed drive operating leverage, which I'll share with you what that is a little bit later in the video and show you the evidence of UiPath generating operating leverage. For the full year 2025, the company is forecasting revenue of about about 1.55 billion, annual recurring revenue of 1.725 billion, and non-GAAP operating income of 295 million. All great forecasts. Let's take a look at them one at a time. The non-GAAP operating income of 295 million compares to its non-GAAP operating income for the fiscal year 2024 of 233 million. So you have 233 million in fiscal year 2024, and then you have 295 million in fiscal year 2025, an increase of about 62 million in non-GAAP operating income year over year. That's roughly 25% improvement in operating income. For revenue, 1.55 billion in 2025 compares to 1.3 billion for 2024, so an increase of about 250 million in revenue year over year, or a little bit around 20% revenue growth, while profit is also increasing. So solid growth, to be sure, expected from UiPath in its next fiscal year. I told you I would highlight how the company is generating operating leverage, and here I will do precisely that. The company increased its revenue from 1.058 billion in 2023 to 1.308 billion in 2024, in the 12 months ended January 31st, 2024 to be precise. But at the same time, its total operating expenses only increased by about 50 million. Its revenue increased by 250 million. Its operating expense increased by only 50 million. Notably, its sales and marketing only increased by roughly 12 million or less than 12 million, while its revenue increased by 250 million. To me, that demonstrates organic demand for your product, where clients really want your service. You're not having to entice clients to purchase your service with promotions and incentives and advertising and marketing. Clients are purchasing your service because they see a strong return on investment. That's a good sign. I always like to see that when I'm considering an investment. Additionally, general and administrative expenses decreased from 239.5 million to 231.6 million, while revenue increased by 250 million. This is my least favorite expense for any company to have. This is where you have your corporate headquarter expense, furniture for your corporate headquarters. Maybe this is where if you do a annual Christmas party for your office, travel expenses for your management team. Maybe you have an expense account for your senior management team. All expenses that I feel that get wasted or get overdone, I feel are mostly in this general and administrative category. So I'd like to see this category reduced and minimized as much as possible. I like to see spending falling in that category. The area where I don't mind spending increasing is research and development. This is where you develop new products that you eventually sell, and this is where you develop competitive advantages. This is where you develop proprietary technologies. This is where you differentiate your product and you're able to sell at premium price. I don't mind companies spending money in research and development. In fact, I oftentimes encourage it, especially from companies that have demonstrated success. If you're good at doing what you do, I want you to do more of it. And so I don't mind companies spending more on research and development. It's the other two areas, sales and marketing and general and admin, that I'm not too fond of. And UiPath is doing all of the things that I would like to see if I was an owner of this company, which I am not. I do not own shares of UiPath stock. I have recommended it as a buy, but I don't own it myself. So to update my recommendation, I want to finally look at the valuation. It's right now trading at a forward price to earnings of 33.76. So all things being considered, I'm keeping UiPath stock rated as a buy following its latest financial earnings update. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.